Everyone, and welcome to Top Pro Traders Have the Mic. This event is brought to you by Timing Research, represented by David Kosmeter, and Trade Out Loud, represented by myself, yours truly. With us today, we have Rob Smith from T3 Live from 10 o'clock, top of the hour. At 11 o'clock, we have Jeremy Newsom from reallifetrading.com. At 12 o'clock, yours truly. And at 1 o'clock, we do have Matthew Buckley from Top Gun Options. And we also have Jim Kenny from Options Professor. Before we begin, let me remind you that all information provided today is for educational purpose only and should not be construed as investment advice regarding the purchase or sale of securities, options, futures, forex, or any instrument of any kind. Trading involves a high level of risk and may not be suitable for all investors. You could lose money. So before deciding to trade, you should carefully consider your objectives, your level of experience, and your risk appetite. Individual performance depends upon each person's skills, time commitment, and effort. Results may not be typical, and individual results will vary. You must do your own research and make your own trading decision. So first presentation, Rob Smith from T3 Live. He is the director of Quant Edge program, and he's going to be joining us in just 1 minute.
Okay, good to go.
Rob, you're on. You have the mic.
Oh, excellent, excellent. So welcome everybody, especially people who have never heard what I'm going to talk about today. Hopefully everybody can hear and see. So let's get to it. What we want to do and talk about is trading only what we know to be true. One of the problems that people have is that they've been taught a lot of falsehoods and a lot of subjectivity. And one of the things that is most difficult for a lot of people is the mental aspect of trying to put a bunch of information together. So let's get to it. Am I getting my mouse here? So if you've never heard of me or who I am, I've been, as of this month, I've been in the full-time in this business for 30 years. I started on the CBOE when I was 15 years old in the Houston Oil, Texas Instruments pit. I worked every summer through high school and college on the Midwest Chicago Stock Exchange. Then I became a member of the Chicago Stock Exchange for 16 years. I was an independent trader. I was also a listed and OTC specialist. I provided a lot of research to several firms down there. And what I would do to try and figure out how this all works is I read every book on technical analysis I could ever find, summarized them all, wrote them down. And the problem was there was an asterisk at the end of every one of those books. Some things work in some markets, other things work in other markets, but there's no what kind of a market indicator are we in. So I just threw it all out. What I did was then go into what I call immersion, where I wouldn't try to analyze charts. I would just have to see them. So I would look at 2,500 to 3,000 charts a day, just trying to look for some commonalities of things before they move, what's going on when they move. And it took me 20 years, but I figured it out, and another 10 to refine it. But we're going to show you that today. So what do we also know to be true? We also know that almost everybody who attempts to trade for a living fails. Almost everybody, right? It's the attrition rate of this business is possibly the highest there is, right? You've probably smashed a few keyboards in your day, right? You're like, oh man, or you make a little, give it all back. So if this is true, and we know that is, right? Most people don't make it. And there's all this information out there on how to make money, but nobody does, right? So there has to be a problem, right? So if you use the scientific method, basically, we have to identify that there is a problem, right? Identify what that problem is, prove it's that problem, and then solve that problem, right? So if all traders, right, have one commonality, and they're from all ages, both sexes, all over the world, what commonality would be the problem? Right here, technical analysis software. Everyone uses it. It's got to be the problem. It's the only commonality to what all people use trading, right? So if that's the problem, now we got to prove that's the problem, all right? So let's start with this guy, Fibonacci, right? And you'll see people that are constantly taking their software, right, and saying, oh, here's my pivot and going up, and here's my 0.618. it's irrelevant, all right? If you could do that, right? It's mathematics, which is an exact science. If you could do that, what you could do is you could go back in time on any chart and show me the exact Fibonacci mathematics of every move and every retracement, everyone, right? You know what people don't use? They don't use a calculator, because if you did, it would never line up, ever, right? And so therefore, it's completely irrelevant what you think you see when it comes to Fibonacci mathematics and retracements. Also, you'll notice that people don't use a calculator. They just use the software and go from here to here, and it's around there. Well, if you ever took a math class and you only had one question on it, and it was 2 plus 2, the answer is 4. All right. Otherwise, you get an F. All right. So don't tell me that this lines up with anything ever. Right. Completely false. Moving averages, MACD, STOs, anything that's considered an oscillator or a momentum indicator. No way. Not possible. That's why they call it a lagging indicator, which is an oxymoron. It's not possible, because the problem here is that people are attempting to apply the wrong science. They're assuming, because they live in a physical world, that price action is physical. So when you're looking at a screen, it appears price is moving. That's not what's happening. Price aggregates, which means that you have to have a buyer and a seller for every sale, right? And those participation groups are constantly changing, right? So when you're trying to gauge something that's not moving, right, it's completely false. So here's the problem. When people say, I'm trying to use this to gauge momentum, price can't have momentum. It's an analogy. It's like it does. Momentum is mass times velocity. Do you know what price doesn't have? Mass. Therefore, it doesn't move. It can't move. It's not possible. So if you're trying to use a momentum oscillator or indicator for the price movement, what you're doing is using an oxymoron to try and prove an analogy, right? To try and predict an analogy. It's similar to if you watch sports, and a sports announcer will come on and say, this team's really got momentum coming in the playoffs. They don't actually have that. It's an analogy. It's like they do. If they did, they wouldn't have to play the game. They just apply the formula here, and they'd tell you who could win. But it has nothing to do with the future of where the price is going. Nothing, because it can't. It's not even an argument. Pattern recognition. This is another good one. It's irrelevant what you think you see. It's a Rorschach test, right? That psychologists give people to find out if they're nuts or not. Is it a bull flag or a bear wedge? I don't know. Let's go on Twitter and have a vote. It's ridiculous, right? What you think you see is irrelevant. Price could still go up or down or sideways no matter what you see, and you know that, right? That's why you'll see for every pattern, you'll also notice there's a failed that pattern, which makes it completely irrelevant. Also, if we go into the software aspect of it, you'll realize that software is going to present charts to you the way it wants, right? So if you have a chart, a daily chart that updates from the opening to the close, and you have another one that starts at noon and goes from noon to noon, those charts are going to look completely different, right? Do you understand that some software companies have their 60-minute update at the top of the hour? Other software packages have 60s that update on the bottom, and those two charts look completely different, right? So when somebody's looking at one time frame chart daily to try and tell me where they think it's going, they're out of their minds. All right, they're looking at such a micro snapshot of what actually is going on, and what they're betting on is the repetitive nature of price action and their screen time, right, of looking at things over and over again, right? That's all they're betting on, screen time, to see the repetitives as they've seen it, right? And I'll tell you right now, nobody has more screen time than I do, right? And it's irrelevant until you understand what's going on. So pattern recognition, here you go. These are all nice. You'll notice that these are not actual charts. What they are diagrams of what a perfect world would look like if these things actually worked, right? It's ridiculous. Throw it out. It's subjectivity. This right here is possibly the biggest miss in any industry's history that I can possibly think of. This belief right here cost me 20 years of work. the broadening formation. You'll notice that in any book, right, on tactical analysis, they will say that it is extremely rare, right? Unusual and relatively rare. That's false. It's actually one of the only things that can happen, as I'm going to show you here. And everything else, subjective. But a broadening formation, as I'm going to show you here, is one of the only things that actually can happen. Here's another good one. Algorithms keep picking me off. Well, it's a pretty convenient excuse for not knowing what you're doing, but it's not true. People think that there's algorithms that actually come down, take their order out, and then go back the other way. That's not true. So any algorithm that's picking you off is going to be high frequency, and you're not even going to notice it. So to a certain extent, that can be true. They can front run your order by a millisecond and be out by the time you're in. You're not even going to notice that. 70% or more of trading is automated, right? And so there's a difference between high frequency trading and automated algorithmic trading. Robots are stupid, right? They have to tell them what to do, right? So if you're going to have an algorithmic setup, execution system set up, there's 3 things that you have to tell that program to do. 1, what do you want it to do? Buy or sell. 2, when do you want to do it? 3, how are you going to do it? As I'm going to show you, it's very obvious what they're doing during the day. We can see exactly what they're doing. So you've probably heard this from many people before too. Oh, there's no holy grail in trading and we're always learning. I'm like, if you're always learning, most likely you're getting schooled, all right? I'm going to tell you there is, and I'm going to show it to you right now. There's only 3 universal trees, 3 universal scenarios. There's only so many combinations thereof that can possibly happen, right? And once you know that, we put it all together and trade something we call the strategy. The strat for short. Now I'm going to show it to you right now. Now, from one bar to the next, there's only 3 possible outcomes. Scenarios, if you will. Scenario 1 is an inside bar. First one here, not strong enough to take out the previous high, not weak enough to take out the previous low. Inside bar, scenario 1. Scenario 2, you take out one side of the previous bar here to the upside. That's trend. Can't dispute that. Now, the third and possibly the most important, you take out both sides of the previous bar. You take out the highs and the lows. Is that important to know? You bet it is, because it's the only way to gauge magnitude, how far you can expect something to go. Once you can't go 3 without going 2 first. You have to. When you start coming back to the previous range, because we know outside bars exist, because there's only 3 things that can possibly happen, our magnitude is to take that out at least. Now, no matter what anybody has ever told you, high capitulation volume combined with this and a non-confirmation? No. There's only 6 ways that price can possibly reverse, and you don't have to know all of them. These are 3 of them, 3 of the most common. Because when somebody says reversal, almost every time they're thinking about a major reversal, major bottom, major top. That's not true. You ever heard somebody say, I'm going to buy it out of pullback? I'm like, well, what's a pullback? When it pulls back? When are you going to buy it? Support, or when it looks like it's not going down? No. A successful pullback, more often than not, is going to look like one of these 3 reversals. 2 in one direction. 1 inside bar. 2 in the other. It goes down, forms the equilibrium between the buyers and sellers, back up. 2 in one direction, 2 back the other way. All right, 2 up, 2 down. Then the outside bar. 2 up, fails, comes back and forms an outside bar. If you know these three, you're pretty good to go on what a pullback looks like. One of these things, all right? Like I said, there's a few more. But now, going back to the broadening formation is rare. No. By changing time frames, right? What you'll see here is this is Google Daily. An outside bar 3 takes out both sides. Now, by going down in time frame, you're going to see a broadening formation. You have to. It took out both sides of the range. Here you go. Boom, 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 boom. When we come back in here, where are we going? We're taking these guys out because the broadening formation gets bigger, right? And so conversely, as opposed to a traditional pattern where somebody's trying to figure out what's going on, right? We know that an outside bar is going to look like this, right? We also know that we don't have to have time frames that are being presented to us to know that, right? We can change things in our minds. So you'll notice that from here to taking here from all these guys, this 1, 2, 3, 4, 5, 6, 7, 8, 9 bars, right? If this was a 9-bar chart, would be an outside bar of all this. We know that. So that's how we gauge magnitude when things are coming back through. Now, all right, just one more. The outside, inside, 3, 1, 2 reversal. That happens too, but we'll save that for another time. Phone's ringing, eh? So now, when people try to gauge direction because it's over a moving average, it's irrelevant. That means it's already moved higher, right? So if we go to, it's like if something's above a moving average, it's irrelevant. You may have noticed some of the greatest sell-offs in the last few years occurred over the 200-day moving average. It's irrelevant. So then, how perchance would we gauge direction properly? Well, like I just said, pattern recognition by using one time frame, single time frame analysis, very incomplete because of how software is presenting it to you. And it could have started a weekly chart on Wednesday at noon. It's going to look different than a regular weekly chart. To mitigate this problem, you need to look at least 4 time frames, no matter what you're looking at least 4. For longer term stuff, I start at yearly and quarterly charts. The main sections, the main section here is going to be your monthly, weekly, daily, and 60, right? So we also have intraday time frame continuity where we go 60, 30, 15, 5, 3, 1. But here's what I'm going to show you. So when you have a monthly, weekly, daily, and 60-minute chart, right? And those openings are separate. What I mean by that is on a Monday, the weekly and the daily, what's going on my phone there? The weekly and the daily are going to be the same chart all day. The 60 daily and weekly are going to be the same chart for the first hour, right? So on the second hour of a Tuesday, depending on when the monthly opens, we finally have 4 separate openings of the 60, the daily, the weekly, and the monthly. Is that important to know? It is, because now we can identify 4 different participation groups by price and time. So when each of these bars are green, price is aggregating on the offer. It has to be. That means the buyers are more aggressive. They're taking the offer, right? They have to be. There is no other explanation. They have to be doing that, right? Is that a good thing to know about? Sure is. That tells you what direction the price is aggregating in. Going back to the robots, if 70% or more is algorithmic automated trading, guess what they told them to do when you see this on your 4 charts? First question, what do you want to do? Buy. When do you want to do it? Now. How are you going to do it? By taking the offer. That's exactly what they told them to do. We know exactly what they're doing when you see this condition. Now, based on what I just told you, let's go back, and these are monthly charts of the S&P, the small cappers, the Qs, and the diamonds. Anybody remember last October? Let's take a look. If you're looking at the diamonds in October, you would have known on the monthly chart 2, fail, change of continuity, now red on the month, boom, outside bar. Is that one of the reversals? It is. If you go to QQQ, 2 goes 3, continuity to the downside, red. Boom, would you have known about that? We did. S&P Spider, 2 up, 2 down. Boom, in October. Did we know about that? 2-2 reversal on the monthly? Sure did. How about the small cappers? 2, 1, 2. Boom. Did we know about that? We sure did. All right. Now, then we have the insider to try and get chopped up and get your money back in here in November, right here. And then the 2, 1, 2 measured move December. All you'll see time frame continuity with all red. That tells you that tells you which way it's aggregating. Now you come back into the beginning of this year. What happened? Uh-oh, change in continuity, new year, SPY, boom, goes green here, here. This is where full time frame continuity kicked back to the upside. Did we know about that? We sure did. January, inside month. Is this a 2, 1, 2 reversal? I think it is. Is this 2, 1, 2 here in the diamonds? It is. How about the Qs? Did we know about that? Small cappers, did we know about that? We sure did. So then, if we go just to the SPY, just the SPY, I'm going to show how simple this is to understand once you understand this, right? October 2-2 reversal, 2 up, 2 down. Inside bar, consolidation. Boom, time frame continuity to the full to the downside, trend, break. Boom, change in continuity here, inside bar, up. Now, you come into May, what happened? Uh-oh, 2 up, boom, turns into a 3 when continuity changes. Where's our magnitude? Here, boom. What happened in June? Oh, let's poke back down here and change the magnitude here to have another outside 3 bar. Do we know about that? We sure did. Also in January, when here's the change in continuity, here's also the 2-2 reversal. 2 down, 2 up, all right? 2 goes 3 here last June. So this 3 helped that monthly go 3 outside as well. We know about that? We did. Everything ever. Okay, we can skip that one. Now, here's another thing that's true. Almost no active fund managers outperform the S&P. That's ridiculous. What are these guys doing? You actively manage a fund and you can't beat the S&P? Why don't you just buy the S&P? Right? No, but I have to have my manager. I'm to do it, get my feet. Yeah. Now, if we go back, right, to the year I started 30 years ago, and you are a fund manager and you knew what I just told you, and you were saying, I'm not going to be really active, right? Rob, can we just do it on a longer term chart so I don't have to jump around so much? Let's take a look. 1989, 2 up. 92, 2, 2, 2, 2, 2, 2, 2, 2, 2. Now you get to the year 2000. 2 still closes a 2 up. And then what happened? Boom, 2-2 reversal coming into 1991. Reverse, get short. 2, 2. Uh-oh, now we're 2003. Inside year, right? The 2-1-2 reversal back up on the yearly basis. 2, 2, 2, 2. Uh-oh, financial crisis coming. 2-2 reversal on the yearly coming into 2008. Boom, reverse, get short. 2. Uh-oh, 2010, 2-2 reversal. Time to get long again. 2, 2, 2, and right off into the sunset. Now, once again, when you train your mind to see things that software is not presenting to you, right? We know where the magnitude is. You see this here, here, and here. You'll notice if this was a 3-year chart, that would be an outside bar of all this. You'll also notice by using continuity, you would have known that this thing was failing so long as this was red and the monthlies and the weeklies and the dailies were red. You would have already known about that. How about here? But you wouldn't have to wait for the inside year. You'd already have continuity going back to the upside. You would have known about that. Same here, right? Does it work at everything, Rob? Everything all the time, because it has to. There is nothing else. It's not possible for price to do anything else. So if you take a look at gold, here you go. 222 yearly, 22222. What's this? Uh-oh. 2012, 2013, 212, bam. And then we come into here, we have the inside, and then 2 and 2 and marching back up, and the rally you're seeing right now. So some people might say, well, maybe this is just a recent phenomenon of the last 30 years. Nope. Let's go back to the year I was born, 1964, to the year I graduated high school, 1983. You'll notice here, lower low, higher high, lower low, higher high. These would be an outside bar of all this. And here's your broadening formation series, 89 crash, boom, stop them out, up through here. So one of the reasons that we want to come back through a previous range, 3, right, with time frame continuity, the moves oftentimes will be faster. The aggregation speeds up. Why? Because when you come back through a previous range, the people on the wrong side have to gauge where they're going to get out by something. Do you know what they've been told? I'm going to put it out. I'm going to do it out the pivot. I mean, 1 cent above the pivot, or where I got in. Yeah, we know that. So when you come back to a previous range, right, and you have full time frame continuity, which means by time and price, the buyers are more aggressive by taking the offer. You are also hitting stops, which runs the price. So if you told a computer to take the offer and the stops are running it, that computer is going to zip it right up because it's been told to buy. Robots are stupid. Now, how could we even more fully take advantage of what I just told you? We use them on decaying products, namely TVIX, VXX, UVXY. These things are designed to go down over time. They have to. They don't have a choice. This is directly out of the TVIX prospectus. You don't have to read it all, right? But I'll sum it up for what it says in here. In almost any potential scenario, closing indicative value of your ETN is likely to be close to 0 after 20 years. We do not intend to expect any investor to hold ETNs from inception to maturity. It also says if you hold it overnight, you can expect to lose. It's for intraday hedging only, right? You think that's going to work with full time frame continuity to the downside? You bet it is. It's like bread and butter. Just a little bit more of the history that how easy it is to understand. When I had a very rudimentary understanding of this, right, back in 2010, but I started to see it in November 2009. It was a Fed day, and announcement came out and they're cutting rates, right, which was discernibly a good news. And the price went up and then dropped and then shot up high, right? Now, why would that happen, right? That's why you always see people on Fed days be like, is the first move right, or is it the second move? I forgot, or is that the third move? Why that occurs, okay, is that you create order vacuums. So when known news comes out during the day, right, and it's good, boom, you'll see a bunch of guys going right at buy it right away, and it spikes up. Now, the first guy that takes profits, there's nothing down there. There's nothing left. You just wiped out all the orders. Boom. So it collapses back through where that price was when that announcement came out. Now you get the guys who held off to say, false breakout. Boom. Now I'm going to hit that right there. Get short, right? But the news is actually discernibly good. So that creates a bigger order vacuum on the way back up, right? So boom, as soon as anybody tries to buy or shorts cover, boom, this thing goes to the moon, right? And so that formed was a broadening formation, which I saw, and I was like, I went to that book, and it was said that it was rare, and I was like, I started looking at it, I'm like, this stuff's in everything. I'm like, this is all that can happen. So going back, I used to write the In the Black newsletter in 2010, and Monday, May 3rd, I wrote about this. I saw this in the VXX, a half triangle in the diamonds, and the VIX itself. And you can see this half broadening formation here, right? And I was like, whoa, if this is the half of the broadening formation on the VIX, it's like the results would be catastrophic, is exactly what I said, right? Remember when I wrote this? Monday, May 3rd, 2010. May 6th, flash crash, Dow down 900. Do I say that I called it? No, I don't. We don't do that. We react to things that are happening. What I said is, if anything goes wrong, the setup is there. That's how important gauging magnitude is. Because I'm going to tell you right now, do you know how to call somebody out who doesn't know how to gauge magnitude? They'll be the guy that said, I think it's going from 40 to 50, right? And it does. Price goes from 40 to 50. And he's the first guy to tell you, I told you. You know how you can call him out? You know, listen to what he says next. I'm selling out my last piece up here. If it's going from 40 to 50, you've been selling? Well, it's prudent to take some profits on the way up. No, it's not. Not if it's going to 50. I want to be as long as I've ever been, right? So we use all these reversals and everything. So long as we have continuity, we are continually adding to our winners. We cut our losers immediately, right? And you add to your winners so long as we still have continuity and we have the magnitude of the longer term triangles. And this is a little bit off the screen here. Tough to see, but here's what you do, right? Here's what I want to tell you what you do. This is an email I got from a friend of mine, Randy, that I want to visit. And it's a little tough to read in here, but I'll tell you this. Here, as of this email, he was up 286% trading the futures. I visited him up in Wisconsin in July. Through July, using this information, only trading the futures, was up 340% this year. So what you do is you listen to me and you learn this stuff, right? And you profit from it, okay? Because there can't be anything else. It can never change. So when people say markets are always changing, they're dynamic, that's not true. The only thing that changes is the speed and method of execution. That's it. But outside of that, 1, 2, 3, and time frame continuity, that's all there can ever be. It's impossible. So what you do then is you learn, you use this and are profitable, and then you tell people about it. This problem has been solved, all right? I'm telling you right now, this how things work has been solved. So my friend Steve Burns, he's an Amazon influencer, writer of several books, the biggest reviewer on Amazon on books on trading. He has, I believe, 180,000 followers on Twitter. I wrote an article for him called "What Do We Know to Be True?" about price action. And the last I heard from him, he's like, I don't know if it's the most read I have, but it's up there. He's like, it's up there. And he tweets it out all the time. He was stunned. He's like, I've never heard anything like this in my life. I'm like, I told you. Now tell everybody. So you learn, you profit from this, and you tell people about it. All right? This problem's been solved. All right? Then what you do is you help other people learn it. Right? Help other people. So as of right now, I have meetings this weekend. 2 software companies are already going to start putting this stuff in their software, right? So as of right now, this guy Kirklebein, another guy board writer on my Twitter, they've already transferred some of this stuff over to where software is already going to be converted to what I just told you, all right? All that other stuff's going to go away, all right? So this will have, charts will have 1, 2, 3 right on it, right there. And you'll be able to search for these different combinations of reversals and where they are. Also, you might want to write this checklist down. I already know what your winning and losing trades look like because they have to. Your losing trades look like this. You got chopped up trading a scenario 1. It's consolidating. It's getting tighter. You fought a scenario 2, right? It's punching you right in the face. You got destroyed by a scenario 3. That happens all the time. If you've ever made a little, and then lost it all and then some, that's what happened, right? The range started to expand on both sides, and you got cold cocked and had no idea what was going on. Or time frame continuity against you. It's aggregating in your face, right? Would you like some more stock, sir? Right? And winning trades look like this. Scenario 2 in your favor. Scenario 3 in your favor. Time frame continuity in your favor. It has to. You have to have some of that going your way if you're going to have a winning trade. It's not possible. Do anything else. So you learn this, you profit from it, you tell people about it. All right. Oh yeah, and one more thing. Once you get this down, you teach your kids. My traders, some of my best guys are training their kids to do this. It's just it's a very simple, rudimentary understanding, like a video game, right? Foreman, Blaine, NTES paid for the spring semester. Now switch to pay for the next year, teach him early. Blaine is at Ohio State. Last year was a freshman there. He had 2 days. We paid for the whole year. 2 days. His sister Jenna's 15. She wants to buy a car when she turns 16. Foreman says, sit down. Ulta options trade, there you go. Sell 12, sell 6, make $3,000 or work 300 hours at $10 an hour. You teach your kids to do this. It's not that hard. I think from what I'm showing you, if you can count to 3 and you can see if something's green or red, you're good to go. Yeah, the record holder, Allison. Allison, 12 years old, on her first day doing this, was up 1,300. Her first day. She just turned 13 recently, but she's a record holder. And there she is. That's Allison, right? Now, what Allison did with that money that she makes, she's very consistent. Here you can see this. She bought her and her sister Apple Watches from the Strat. Isn't that nice? Love that. Ladies and gentlemen, I give you the Apple Watch girls. Allison, what do we do when the price is aggregating on the bid? Full time frame continuity to the downside with a reversal in that direction. Allison shows me her iWatch and says, hit him. Boom. She knows what to do. She hearts the Strat, and of course, she bought the watch with her sister, Abby. Triangle layout is a term that we use to describe that one of these reversals is indeed about to occur and kick back into full time frame continuity our way. We say triangle layout, right, Abby? And then what do we say? We say get, and that's a nice iWatch you got there, all right? We say get because we know how to gauge magnitude. Where's it going, Rob? There, right? Are we sure about that? Mm-hmm. If we don't have a reversal against us, that's where it's going. Are we going to sell some because it's prudent to schnitzel some? No, we're buying more. So this is my desk, and often people are like, man, what do you need all those screens for? I'm like, it happens in everything all the time. We can't get to it all. What we usually say is more hands, more eyeballs, more keyboards, right? Because we can't get to it all at any given day, especially when you have a simultaneous break, which means that the futures and almost every ETF is breaking in the same direction. We can't get to it all, right? The best we can do is gauge the biggest magnitude ones, or the most liquid ones, depending. Everybody uses this for multitude of different things, but that's what I'm doing constantly during the day. I'm scanning this out. It is constantly changing. There's constantly new 2-2s. There's constantly things going 1. There's constantly things going outside on the 3, and I'm monitoring it all because it happens in everything. So exactly what is it that I do then that I'm doing that? So what I do is I train you to do this in a community of people who are very efficient at this, right? And they're very helpful. Once you know this, you're good to go. You don't care what anybody says. You don't care what I say. You know what's happening. We don't think, we know. So if you use if you're on Twitter, go to hashtag the Strat, and you'll see people who know this, right? Those are the people you want to follow. You want to listen to these people because they know it. So what we do is we have a strong community of people who've been doing this a long time. We have scans for it all, right? Thinkorswim, TC3000, we have scans for it all. Here's all the ones, here's all the twos, here's all this, right? Here's all these setups. Software, like I said, is already being converted. Then we're going to have more and more gear on this. So I have a 12 video course. I have more information coming out with the scenarios on it. We have stuff like I basically give it away. The Strat I basically give away on my YouTube. But what I do is you and the community train you. I'm on the headset 7 hours a day, just calling this stuff out, monitoring it. Where's it? What do we got? What do we got? I make a video every night after the close about a few things that we're going to be looking for going forward. All right. for the next day. On Monday through Thursday on the T3 Live Facebook at 12:30, I come on for 15 minutes, halftime show. I tell you exactly what we're looking at going forward because we know what's happening, right? There's no, I think this could be a buy. I got buys, dude. I don't got buy ideas. It's a buy, dude, or it's not, right? Tuesday, 1 hour after the close, I go back to the T3 Live YouTube for the Wheels in Motion show where I tell you what we're looking for going forward through the rest of the week and why we're looking for it, why we're looking at it. Here's all the twos on the weekly. Here's all this. Right? On Thursday, an hour after the close, I come on for a coaching session, group coaching session. There'll be people there that I will tell you don't really need to be there, but they're there to help you. And I'm going to tell you right now, there's people listening to me right now that don't have to be there, that do know this, right? They just like to hear it again, right? And so the community is very strong. So coaching session goes for an hour, hour and a half. Every Thursday it's recorded to make sure everybody gets it, right? Here's what you do. Here's what you do. Here's how you set up your software. Here's what you're looking to execute on, right? So every Thursday, and that's recorded. On the weekend, I'm making a more extended weekend video where I go through the broader averages, major sectors, and stocks of what we're looking at and why, right? Where these things are going to kick in. Once a month, I make the macro video. That's where I review the quarterly and yearly charts, right? Like that SPY I showed you in that gold. Yeah, if you looked at some of that going back, you would have seen the 212 Netflix 3 years ago. That's people are still long, right? All that kind of stuff. So I do that, and I do that at T3 Live. And to show you that I'm not just another one of them carpetbag hucksters, which are like $5,000 of education, and this has every pattern and indicator. You come for 1 month, I charge you $49. $49, I completely change your life. You'll see things completely differently once you get all that garbage off your screens that have nothing to do with the outcome, and you will be set free, indeed. And those who are free indeed, all right? So at that point, I think, let me see if I can see if there's any questions here. Thanks for coming out. And there are some people in there saying, yeah, I'm here. And I believe this is recorded so you can watch it again, correct? And let's see. If anybody's got any questions for me, let me see. Still sounds like pattern recognition to you? No. It's condition. There you go. Want to learn more? Good, good, good. Yeah. So all you got to do is go to T3Live.com, tell them Rob sent you. And Anka, if you're there, I'm not sure if we have a link that we can put in for you, the $49 link. You just tell them Rob sent you and you want to come for $49. All right. When I quickly show the scenario, sure. So if we go back here.
Hey Rob, this is David. I found the link you sent me, so I'll post that in the chat right now.
Cool. We're putting the link in the chat right now. $49. I will change your life. All right. So the three scenarios here.
And I'll also just want to add too that the recording will be on the homepage of TimingResearch.com later today, after the presentation ends. So.
Okay. Thank you. So here we go. So the only three possible things can happen is an inside bar. Here. You can trade that? No. 2, take out one side. You can trade that? Yep. 2 goes 3. That's all that could possibly happen. A losing position? Immediately. Once 1 Mississippi, 2 Mississippi, out. When you have time frame continuity, we have every reason to believe this is going to work. Why is this not working? We have an unknown participant, right? Unknown participant. So like I said, it's like for $49, I mean, really, it's like, after what I just told you, I'd say that your bigger risk is not listening to me. It's like, if I just told you that I've completely figured out how this works, right, and it can't be anything else, I think the bigger risk is not. 1 is an inside bar, correct. Inside bar is 1. Taking out one side is 2. Taking out both sides is 3. And the other great thing about our community that knows this, We can relay information to each other very quickly. It's not a, hey, let's have a discussion. Is that support? Is that the, no, it's, that's going to. Here's full time frame continuity, 2-2 reversal there. This has got this here, right? We can go back and communicate with each other very quickly, right? On all time frames, correct. Yes, it is fractional on all time frames. And how important are the tops and bottoms and wicks of entry exit point? They matter because that actually traded there. So we're using the entire range because that actually traded. So when people try to tell you it's only important to have the body of the candle, I'm going to tell you if you got stopped out up there, it matters to you. It matters to me. That definitely happened, right? And so basically any two is actionable. It's a matter of how actionable based on, do we have reversals? Ideally, we want reversals back into the direction of time frame continuity. You can go directionally too and keep going, right? We prefer to get the reversal in our direction. And then if you have a continuation, you can add on that. Why? Because we're already playing with house money, right? We always want to play with house money. I don't want to play with my money. I hate playing with my money. But once we're up and we're profitable, I'll go nuts. Just add. Because if you've ever said this before, I got out too early, right? Yeah, right? So you want to load the boat. Then will be something called exhaustion risk. That's when you go into new highs or new lows. That's why people will say you don't buy directly into new highs. You wait for a pullback, right? It's exhaustion risk. What that means is that time frame continuity also can represent a crowded trade, right? If everybody's buying, eventually everybody's long, which is bad. Somebody has to take profits. So when you come back to a previous range and you're ripping through, taking all these stops out, if the buyer doesn't step up into the new highs, stalls out, right? Because you've already taken this taken all the stops out. There's nothing there, right? So the buyer can sit on the bid, but you can sit on the bid all day. Price isn't going higher until the buyer starts taking the offer again. And the great thing about it, even if you're skeptical, which I don't know why you would, is that it's very simple to understand. It's very simple. Is it going up or down? Okay, then let's buy things let's go to the price is rising. Buy things are going up. People are always trying to pick bottoms and getting destroyed. Oh, I bought it because it's oversold. I'm like, how come you lost? It's got oversolder. It's like, no, it's a bounce play. Can't bounce. That's physics. Okay. There we go. Shop 1130, rev strat 30 and 60 down combination. There you go. Yeah, we can sit here and look at charts all day. It's in everything. Once you start looking at this, all you're going to see. It's all you're going to see. And then you're going to see it in your sleep. And then you have to teach your spouse, because then all your friends are us. You have nothing to talk about anymore. Trust me, that happens too. Okay. Any more questions? You can also follow me in that Twitter. I try and follow back. So if people have questions, I'm very accessible. And I just moved to Florida. Otherwise, I'm going to call it the pilgrimage. People come to my office from all over the world all the time. Some people just to sit here and learn. Some people just to shake my hand. But right now I'm in lockdown because we're doing some business here. But after the new year, if you want to come down and sit next to me on the desk here in Florida, be my guest. Right? Can I enter in a 5-minute chart? You bet you can. You can go down to a 1-minute chart. You can go down to a 1 minute. We call them strat ninjas. So some of them ninjas right on the opening are on 1, 3, and 5 minutes, but not everybody's going to do that, and I understand that. The good thing is you don't have to do that. When I teach people this, I slow them down and use 30 and 60-minute charts just on the gap list that I tweet out in the morning. Because you can't have a signal on a 30. The first signal you could have would be an outside bar on the opening 30. The first other 2-2 couldn't occur until the second half an hour, right? An inside bar couldn't happen. An inside 30 can't happen for an hour, right? So you can kick back and just watch them develop. And then the simultaneous break, yeah, boom, that's when everything is going. Yeah, it's a community, not a trading room. Like people who know what they're doing, right? Elliott wave? No, that's subjective. Otherwise, you could show me every move ever, and you wouldn't have to sit there, and you wouldn't have to have an analyst that's trying to figure out what wave of what it is. You would know. right? It's subjective, so we want to eliminate subjectivity. I don't want to have to think at all. I want to know. I know what's happening, right? Algorithms are taking the offer, right? It's a matter of how long are they going to do that. Here's another thing you might not have noticed. The bottom of the hour, we call it the flip. You want to know when a new 60-minute bar is coming. You know why? Because one of those questions that the robots had to answer. When do you want me to do it, right? Now? And then when do you want me to stop, right? And you will see it turn right on and turn right off, right at the bottom of the hour, sometimes top of the hour. But anytime you got a new bar coming, your perception's about to change. So let's say you have a green bar that's breaking into new highs, right? Everybody at that point will say that chart looks good. Now, if you have a red bar that takes that out, 2-2 reversal, now it's a false breakout. The best looking chart is now the worst looking chart, right? We know that occurs, right? We can cause that too. That's another good thing. You can cause it. When like you can't move markets, I'm like, watch me. if I know that humans and computers and every man, woman, and child and bot are more aggressive on the buy side and are taking the offer, I want to be the first guy to do that. Then we ride their wave. Let them take it up for us, right? They will. They will. And like I said, playing with house money is, I can't say this strongly enough. When people are taking losing positions, I'm like, oh, I'll add to it if it keeps going against me. What the hell? I'm like, there's something called the time value of money. I don't have time to sit around here with a loser. Get rid of it, because you know what most people will do? I use this analogy a lot. It's like the bus analogy. Let's say that you picked out 2 stocks. Right? These are your 2 favorite ideas, wherever they are, and you bought them both, right? One goes up, one goes down. Do you know what most people will do? They'll sell the winner to pay for the loser and hope it comes back. That's insanity. It's dead wrong, but most people will do that. And that's like getting on a bus that's taking you where you want to go, right? And you freak out and think this bus is going to turn around and take you the wrong way. So you get off and get on a bus that's going the wrong way, betting that that's going to turn around and go the right way. It's insanity. You cut the loser and you add to the winner, right? But that's what most people will do. If you're having trouble with that link, you can just go to t3live.com. Hit him up. I want Rob. I think he's right. He might be. I definitely got to do that though. Will you day trade a 15 line upwards if daily, weekly going down? It depends on the range, because the higher the level of volatility, the shorter time frames take more importance. So if you looked at something like Roku yesterday, you'll notice that like 1 and 3 minute bars were like normal days, right? And so the higher the level of volatility, the more important the shorter term time frames become. Time frame continuity was the last chapter of the strategy when I developed it, because it was a period of really low volatility, right? And you have to have that. The lower the volatility, you've got to have as much continuity as you can, because things are already not going very far, right? So there's that. There's that. And one of the great things to teach it is watching something like a Roku or something that's really active on a 5 minute, 3 minute, and 1 minute chart. You don't trade it, but it trains your mind to see things. There's the 1-2-2 rev strat. There's the 2 going 3. Here's the inside. And here's the 2-1-2 reversal. You'll see it in everything, because there isn't anything else, right? Yeah, all over the place in Roku. It's great. It's like, okay, sure. So you can get long. You just got to have that magnitude. So because we know outside bars exist, and we can use multiple bars to see outside bars that aren't being presented, once it gets up there, you just take it. Take that magnitude and be like, boom, where's it going? It's going to take these guys out. We're up, right? Weekly option trades? Oh, yeah, definitely. Because what we'll do is when you can gauge the magnitude properly, that can tell you which strikes we want to go after, right? And we're like, because once it starts coming up, then you get through that strike. Then if it's strong enough, what we can do is those weekly options go into parity, then you can sell the stock against it, because if it does the broadening formation back down, you've already locked your profits in and you're protected to the upside. It's called a synthetic put. Then if it goes ripping back through the strike, now you're short with no risk, right? So there's a lot of things we can do with that. We call it cheapo option Friday. We like cheapo option Friday because we can gauge magnitude, right? When people are like, oh, it's not going through there, I'm like, watch this. Watch this. Where's it going up there? Where's the strike there? What's it trading 2 cents? Good, right? Yeah. And like for depending on when it occurs too with the options, and sometimes, like I said, with like Roku on that shorter term stuff, if we're fighting longer term time frame continuity, but it's active enough to do that. With options, just because of the nature of how they're constructed, oftentimes we'll also do that in the options. Just take it. Where's it going, Rob? There. After that, I don't know. But once it goes there, take it. Another thing that people will do, so the office I was in was exclusively options traders. And when I got there, like, Rob, we don't care where it's going. Tell us where it's not going. I'm like, okay, well, I don't know how high it's going, but it's definitely not going down. They're like, thank you. Boom. Bull put spread, right? And you can use, when you have time frame continuity going, flipping back to the upside, that's when you'll have people putting on those bull put spreads and be like, I don't know how high it's going, but I don't care. It's not going down. I wrote on that article. Yeah, if you go to New Trader U, what do we know to be true about price action? That's what it's called. Well, it looks like we're coming up on an hour. I don't want to tread on any feet here, but thank you for coming out today. I always really enjoy telling more people, look, this is 30 years of work, right? And you can see that there's people in here already doing this. They're showing up. They're already got that article ready to go, right? Right? These are all people who are willing to help you, right? Just come, do this, and then help more people, right? I use Lightspeed and NeoVest as my charting package. And there you go. Everybody's got more universal videos here. I have a ton of information. I give it away pretty much, right? And $49, and I just got to keep the lights on. But for that, I'm going to change your life. I'm telling you, if you're going to do this, if you're going to do this for a living, or even if you're just want to know more, in 1 month of me on the headset 7 hours a day, 4 coaching sessions, and watching the community play out, everything changes. You never go back. That's why in my newsletter was called In the Black newsletter. Once you go black, you never go back. I'm going to tell you that once you see things our way, you're not going to believe that you ever looked at it any other way. And thank you.
All right. Thanks, Rob. Great.
My pleasure. Thank you. All right. Thanks for coming out today. Everybody have a great day, and hopefully see y'all soon. All right. And have a great rest of the webinar, gang. All right.
Thanks, Rob.